Warren Buffett's 7 Rules for Real Estate Investing. Have you ever watched your neighbor flip houses for quick profits while you're sitting there wondering if you're missing out on the biggest wealth-building opportunity of your lifetime? Here's the painful truth. Most real estate gurus won't tell you. 90% of people who try to get rich through real estate end up poorer than when they started. They chase appreciation, over-leverage themselves, and confuse activity with achievement. Meanwhile, Warren Buffett, the man who turned $10,000 into $100 billion, has been quietly using real estate as a wealth-building tool for over 60 years with a completely different approach. You know what's crazy? While everyone's obsessing over house-flipping shows and get-rich-quick rental schemes, Buffett has been following 7 simple rules that have generated him hundreds of millions in real estate profits. These aren't the flashy strategies you see on social media. They're boring, methodical, and absolutely devastating to anyone competing against them. Here's what the real estate industry doesn't want you to know. Buffett treats real estate like a business, not a gamble. He focuses on cash flow over appreciation, buys when others are panicking, and never, ever speculates on future price increases. Today, you're going to discover the exact 7 rules Buffett uses to dominate real estate markets, while others lose their shirts. These strategies work whether you're buying your first rental property or building a real estate empire. If you're tired of watching others get rich while you stay stuck on the sidelines, hit that subscribe button and let's dive into the first rule that separates real investors from real estate tourists. Rule number 1. Buy cash flow, not dreams. Here's where most real estate investors destroy their financial future before they even start. They fall in love with appreciation stories instead of focusing on the only thing that actually pays the bills: monthly cash flow. You think you're investing, but you're actually gambling on market appreciation that may never come. Buffett's first rule is brutal in its simplicity. If a property doesn't generate positive cash flow from day one, it's not an investment, it's speculation. While everyone else is buying properties hoping they'll be worth more tomorrow, Buffett buys properties that make him money today, tomorrow, and every day after that. Let me tell you an ancient story from the markets of Babylon that perfectly explains why this rule can make or break your real estate empire. There were 2 merchants in the great city, Arkad the Wise and Bansir the Dreamer. Both men had the same amount of gold to invest in property. Bansir heard rumors that the northern district of Babylon was going to become the next wealthy neighborhood. Property values were sure to skyrocket. Everyone said so. He spent all his gold buying the largest, most impressive building he could afford in that district. The building was beautiful, but the monthly rents barely covered the maintenance costs. Bansir convinced himself this was fine. He wasn't buying for cash flow, he was buying for future appreciation. "I'll be rich when property values double," he told himself. Arkad, meanwhile, looked at a smaller, less glamorous building in the established merchant district. The building wasn't impressive to look at, but it housed successful businesses that paid reliable rents every month. After calculating the numbers, Arkad discovered this building would put gold in his pocket from the very first month, with rent payments that exceeded all expenses by a comfortable margin. For 3 years, both men waited. Bansir's beautiful building in the northern district continued to cost him money every month. He had to dip into his savings to cover the shortfall between rental income and expenses. Meanwhile, Arkad's building generated steady monthly profits that he used to buy additional cash-flowing properties. When a severe economic downturn hit Babylon, everything changed. The northern district never developed as expected. In fact, property values declined. Bansir was forced to sell his building at a loss, having burned through his savings keeping it afloat. Arkad, however, not only survived the downturn, but thrived. His multiple cash-flowing properties continued generating monthly income even during tough times, and he was able to buy distressed properties from desperate sellers like Bansir at incredible discounts. Calculate this for every property you consider. Take the monthly rental income and subtract all expenses: mortgage, taxes, insurance, maintenance, vacancy reserves, and management fees. If that number isn't positive, walk away immediately, no matter how much potential the property might have. Cash flow is the difference between real estate investing and real estate hoping. Arcot understood that gold in hand today beats promises of gold tomorrow. Don't be Bansir the dreamer, be Arcot the cash flow king. How many of you have been tempted by appreciation stories instead of focusing on cash flow? Drop cash flow king in the comments if you're ready to invest like Buffett instead of gambling like everyone else. Rule number 2, buy when others are selling in panic. Here's what separates Warren Buffett from every other investor on the planet. He gets excited when everyone else is terrified. While the masses run away from real estate markets during downturns, Buffett sees these moments as Christmas morning for serious investors. You think market crashes are disasters, but Buffett treats them like clearance sales at his favorite store. The second rule is counterintuitive but absolutely critical. The best time to buy real estate is when everyone else is desperately trying to sell. While amateur investors chase hot markets and bidding wars, Buffett waits patiently for fear to create once-in-a-decade opportunities. Let me share an ancient Jewish teaching that explains exactly why this strategy builds generational wealth. In the old country, there was a grain merchant named Mordecai, who understood the cycles of feast and famine better than anyone in his village. Every autumn, when the harvest was abundant and grain prices were low, the other merchants would celebrate their cheap inventory and spend their profits on luxuries, convinced that good times would last forever. But Mordecai was different. While his competitors feasted during abundant harvests, he quietly bought as much grain as possible and stored it in warehouses throughout the region. When winters were harsh or crops failed and other merchants had nothing to sell, Mordecai's warehouses became lifelines for the entire community. He could sell grain at fair prices while still generating enormous profits because he had bought when others were celebrating abundance. The villagers eventually realized that Mordecai wasn't just lucky, he was following a timeless principle. He bought when the supply was high and prices were low, then sold when the supply was scarce and demand was desperate. While others reacted emotionally to market conditions, Mordecai responded strategically to mathematical realities. This is exactly how Buffett approaches real estate cycles. During the 2008 financial crisis, while everyone else was panicking about falling property values, Buffett was quietly acquiring distressed properties at 30 to 50% below their intrinsic value. He understood that real estate markets are cyclical. Periods of overexuberance are always followed by periods of despair, and smart money flows from the emotional to the rational. The key insight is understanding the difference between price and value. During market panics, prices plummet, but the underlying value of good properties, their ability to generate rental income, often remains stable. Buffett buys when the gap between price and value is widest. Here's your action plan. Start saving cash specifically for the next market downturn. Keep 20 to 30% of your investment capital in liquid form, waiting for the inevitable moment when fear creates opportunity. Set up Google alerts for foreclosure auctions, distressed property sales, and market downturn indicators in your target areas. During the next real estate panic, and there will be one, remember Mordecai's grain warehouses. While others see a crisis, they see clearance sales. While others see falling prices, see rising opportunities. The wealthy don't get rich during good times. They get positioned during good times to profit during bad times. Mordecai became the richest man in his village, not because he was lucky, but because he was patient enough to buy grain when others were giving it away. Rule number 3. Location beats everything else combined. Here's where most real estate investors make the mistake that haunts them for decades. they get seduced by beautiful properties in mediocre locations, instead of understanding that an average property in an exceptional location will always outperform a mansion in the middle of nowhere. You can renovate a house, but you can't renovate a neighborhood. Buffett's third rule is unforgiving. Location determines everything: your rental income, your tenant quality, your property appreciation, and your exit strategy. While amateur investors focus on granite countertops and swimming pools, Buffett focuses on job centers, transportation hubs, and economic fundamentals that drive long-term demand. Let me tell you a story from ancient Rome that illustrates why location creates or destroys real estate fortunes. There were two brothers, Marcus and Lucius, who inherited equal amounts of gold from their father's trading business. Both decided to invest in Roman real estate, but they chose completely different strategies. Marcus was dazzled by a magnificent villa on the outskirts of Rome. The property was stunning: marble columns, elaborate gardens, and rooms fit for a senator. The price seemed reasonable compared to properties closer to the city center, and Marcus convinced himself he was getting exceptional value. "Look at all this luxury for half the price," he reasoned. Lucius, meanwhile, looked at a modest apartment building right in the heart of Rome's commercial district. The building wasn't impressive: basic construction, no fancy amenities, and it cost twice as much as his brother's villa. But Lucius noticed something crucial. The building was surrounded by thriving businesses, government offices, and the main roads that connected Rome to its trading partners. Every day, thousands of people passed by who needed places to live and work. For the first year, Marcus felt vindicated. His villa was beautiful, and visitors were always impressed by his smart purchase. Lucius's building seemed ordinary by comparison. But as time passed, the fundamental differences in their locations became impossible to ignore. Marcus struggled to find reliable tenants willing to travel so far from Rome's center. When he did find renters, they demanded lower prices because of the inconvenience. Maintenance was expensive because skilled workers charged extra to travel to the remote location. Worst of all, when Marcus needed to sell, buyers were scarce because the property's isolation limited its appeal. Lucius's building, however, became a goldmine. Merchants, government workers, and traders competed for apartments because the location saved them hours of daily travel. He could charge premium rents and always had a waiting list of potential tenants. When Rome expanded its commercial district, Lucius's property became even more valuable. Research these location factors before buying anything: employment centers within 30 minutes, public transportation access, quality of local schools, crime statistics, and planned infrastructure improvements. Never buy the best house on the worst street. Buy the worst house on the best street. Marcus learned that beautiful properties in poor locations become beautiful prisons. Lucius proved that ordinary properties in extraordinary locations become wealth-building machines. Rome wasn't built in a day, but fortunes were built on Roman real estate if you chose the right neighborhoods. What's more important to you, a gorgeous house in the suburbs or a modest property downtown near everything? Comment location first if you're starting to think like Buffett. Rule number 4, never maximize leverage. Minimize risk instead. Here's where most real estate investors commit financial suicide while thinking they're being clever. They use maximum leverage to maximize returns, not realizing they're actually maximizing their chances of losing everything. You think debt is a tool to get rich faster, but Buffett knows that excessive leverage is the fastest way to go broke in real estate. Buffett's fourth rule flies in the face of every real estate guru who tells you to use other people's money. Never borrow more than you can comfortably afford to lose. While others leverage themselves to the hilt, buying as many properties as possible, Buffett uses conservative debt ratios that let him sleep peacefully no matter what the market does. There's a powerful story from ancient Greece that shows exactly why leverage destroys more fortunes than it creates. In the bustling port city of Athens, there were two shipping merchants, Alexios the Bold and Demetri the Cautious. Both men wanted to expand their trading fleets to capture more of the lucrative Mediterranean trade routes. Alexios saw an opportunity to rapidly grow his empire. He borrowed heavily against his existing ships to buy 10 new vessels, convinced that more ships meant more profits. The moneylenders were eager to finance his expansion because Alexios had a track record of successful voyages. "I'll make so much money from these additional ships that the loan payments will be easy," Alexios reasoned. He leveraged his fleet to 90% debt, owning just 10% equity in his greatly expanded operation. Dmitry took a completely different approach. He could have borrowed just as much as Alexios, but instead, he chose to buy only 2 additional ships, financing them with 50% debt and 50% cash. His fleet grew slowly, but he maintained strong equity positions in every vessel he owned. For 2 prosperous years, both strategies seemed to work. Alexios's larger fleet generated impressive gross revenues, and he felt vindicated by his aggressive approach. Dmitry's smaller operation grew steadily but less dramatically. Then the unexpected happened. A series of severe storms destroyed several ships from both fleets, and a brief war disrupted trade routes, cutting revenues by 60% for 6 months. Alexios's highly leveraged empire collapsed almost overnight. The loan payments on his 10 ships continued regardless of his reduced income, and he couldn't service the debt with only a few ships operating. The moneylenders seized his entire fleet, leaving him with nothing. Dmitry, however, weathered the crisis easily. His conservative debt load meant he could make payments even with reduced income, and when distressed merchants like Alexios were forced to sell, Dmitry had both the cash and the creditworthiness to buy their ships at bargain prices. Apply Buffett's leverage rule to every deal. Never borrow more than 70% of a property's value, and ensure the rental income covers all expenses plus debt service with at least 20% cushion. Keep 6 months of expenses in cash reserves for each property. Alexios learned that maximum leverage means maximum vulnerability. Dmitry proved that conservative debt ratios create maximum opportunities. The ocean rewards careful navigators, not reckless speed demons racing toward the rocks. Rule number 5, invest in businesses, not just buildings. Here's where Buffett's real estate strategy becomes pure genius. He doesn't just buy properties, he buys the businesses that operate inside them. While everyone else focuses on bricks and mortar, Buffett focuses on the economic engines that generate the cash flow. You think you're buying real estate, but Buffett knows he's buying business income streams. The 5th rule transforms how you evaluate every potential purchase. Always understand the business model of your tenants, because their success or failure determines your success or failure. Amateur investors buy buildings and hope someone will pay rent. Professional investors buy proven business income streams that happen to be attached to real estate. Let me share a story from medieval Venice that perfectly illustrates why this distinction creates vastly different outcomes. In the height of Venice's trading empire, there were 2 property investors, Giovanni the landlord and Francesco the business partner. Both men had the same amount of ducats to invest in commercial real estate along the famous Grand Canal. Giovanni saw property investments simply: buy buildings, collect rent, and profit. He purchased a beautiful 3-story building in a prime location and divided it into rental spaces. His strategy was to lease these spaces to whoever could pay the highest rent, regardless of their business model. Giovanni focused entirely on maximizing short-term rental income, often switching tenants to capture higher rents when leases expired. Francesco approached property investment completely differently. He spent months studying the businesses that made Venice prosperous: spice traders, silk merchants, glassmakers, and shipbuilders. Instead of just buying a building, Francesco purchased a property and then carefully selected tenants whose businesses were essential to Venice's economic ecosystem. He chose a master glassmaker whose products were in demand across Europe, a spice merchant with established trade routes to the east, and a shipbuilder who serviced the Venetian navy. Here's the crucial difference. Francesco structured his leases to align with his tenants' business success. Instead of demanding maximum rent up front, he negotiated reasonable base rents plus percentage increases tied to the business's growth. He even invested time helping his tenants improve their operations, knowing that their success guaranteed his success. For several years, Giovanni's strategy seemed superior. His rental income was higher because he constantly pushed for maximum rents and switched to higher-paying tenants whenever possible. Francesco's income grew more slowly because he prioritized tenant stability over short-term rent maximization. But when Venice faced economic challenges, trade route disruptions, competition from other ports, and political tensions, the fundamental difference in their strategies became crystal clear. Giovanni's tenants, who were paying maximum rents for spaces they barely needed, quickly failed or moved to cheaper locations. His beautiful building sat empty as he struggled to find replacement tenants willing to pay his inflated rents. Francesco's carefully chosen business partners, however, weathered the challenges because they had sustainable business models and reasonable rents that allowed them to adapt. Not only did they survive, but they expanded their operations as competitors failed, increasing Francesco's percentage-based income. Research your potential tenants like you're investing in their stock. Understand their industry, their competitive advantages, their customer base, and their long-term viability. Partner with businesses that will thrive for decades, not tenants who are just looking for cheap space. Rule number 6. Think in decades, not quarters. Here's what separates Buffett from every get-rich-quick real estate flipper on social media. He measures success in decades, not months. While everyone else is trying to make quick profits from market timing and property flipping, Buffett builds wealth through patient compounding that turns modest investments into generational fortunes. Buffett's 6th rule requires a complete mindset shift. Buy properties you'd be happy to own for 20 years, because that's probably how long you should hold them. Short-term thinking creates short-term results, but long-term thinking creates long-term wealth that compounds exponentially over time. There's a profound story from ancient Japan that demonstrates why time horizons determine investment outcomes. In a small village near Mount Fuji, there were 2 farmers who inherited adjacent plots of land, Hiroshi the impatient and Kenji the patient. Both men wanted to create prosperity for their families, but they chose dramatically different strategies. Hiroshi looked at his land and saw immediate opportunities. He planted fast-growing vegetables that he could harvest and sell within months. Each season, he would plant whatever crop promised the highest short-term profits, constantly switching between vegetables, grains, and flowers based on current market prices. Hiroshi's strategy generated quick cash flow, and he proudly showed his neighbors how much money he made each harvest season. Kenji took a completely different approach. He spent his first year not planting anything for profit, but instead carefully studying his soil, the climate patterns, and the long-term needs of his community. After extensive research, Kenji planted bamboo groves, lit fruit trees, and ginseng crops that would take years to mature, but would eventually produce abundant harvests for decades with minimal ongoing effort. For the first 5 years, Hiroshi clearly seemed more successful. He generated steady income every season, while Kenji's land showed little immediate return. Hiroshi mocked his neighbor's lazy approach, pointing to his own consistent profits as proof of superior strategy. But around year 7, everything began to change. Kenji's bamboo groves reached maturity and began producing valuable timber annually. His fruit trees started yielding premium harvests that commanded higher prices than Hiroshi's seasonal vegetables. Most importantly, his ginseng roots, which had been growing quietly underground, became incredibly valuable medicinal herbs. By year 15, the difference was staggering. Hiroshi was still working frantically every season, replanting and reharvesting the same crops for the same modest profits, but his soil was becoming depleted from constant use. Kenji's mature groves and orchards produced abundant income with minimal effort, and his ginseng harvest alone generated more profit than Hiroshi's entire annual output. The compound effect became exponential. Kenji used his passive income to acquire additional land and plant more long-term crops, while Hiroshi remained trapped in the cycle of seasonal labor for seasonal profits. Before buying any property, ask yourself, will this investment be more valuable in 20 years than it is today? Focus on areas with growing populations, improving infrastructure, and expanding economic opportunities. Avoid trendy neighborhoods and hot markets that might cool off quickly. Hiroshi learned that quick profits disappear quickly. Kenji proved that patient cultivation creates perpetual abundance. The bamboo that bends survives the storm, and the investor who waits reaps the greatest rewards. Rule number 7, never invest outside your circle of competence. Here's Buffett's final and most important real estate rule, the one that prevents more financial disasters than all the others combined. Only invest in markets, property types, and situations you completely understand. While others chase exotic opportunities in distant cities or complex investment structures, Buffett sticks ruthlessly to what he knows deeply. The 7th rule is brutally simple, but incredibly difficult to follow. If you can't explain the investment to a 12-year-old in 5 minutes, you don't understand it well enough to risk your money. Every real estate fortune lost started with someone venturing outside their circle of competence, convinced they could learn on the fly with other people's money. Let me tell you an ancient story from the Silk Road that shows exactly why this principle protects wealth better than any insurance policy. There was a successful Persian carpet merchant named Hassan who had built a thriving business over 20 years in the markets of Isfahan. Hassan understood everything about his trade: which patterns were in demand, how to evaluate quality, which suppliers were reliable, and what prices customers would pay. As Hassan's wealth grew, other merchants began approaching him with opportunities to expand into different trades. A spice merchant convinced Hassan that the spice trade offered much higher profits than carpets. A silk trader showed Hassan calculations proving that silk investments would double his money in half the time. A gem dealer presented Hassan with stories of fortunes made in precious stones. Hassan was tempted. His carpet business was successful but predictable, and these new opportunities promised excitement and greater returns. Despite having no experience in spices, silk, or gems, Hassan invested heavily in all 3 ventures, convinced that his general business acumen would translate to any trade. Meanwhile, Hassan's brother Ali remained focused exclusively on carpets. While Hassan diversified into unfamiliar territories, Ali deepened his carpet expertise. He learned advanced weaving techniques, developed relationships with master craftsmen, and discovered new regional patterns that were gaining popularity. The results were devastating for Hassan and illuminating for Ali. Hassan's spice venture failed because he didn't understand seasonal demand patterns and bought inventory at the wrong times. His silk investment collapsed when he couldn't distinguish between high quality and inferior silk, leading to customer complaints and a lost reputation. The gem trading disaster occurred when Hassan paid premium prices for stones that experienced dealers knew were overvalued. Each failed venture not only lost money, but also distracted Hassan from his profitable carpet business. While chasing opportunities he didn't understand, Hassan neglected the business he did understand, and even his carpet income declined. Ali, meanwhile, became the region's premier carpet expert. His deep knowledge allowed him to spot opportunities Hassan missed, negotiate better deals with suppliers, and command premium prices from customers who trusted his expertise. Ali's focused approach generated higher returns with lower risk than any of Hassan's diversified ventures. Define your circle of competence clearly and honestly. If you understand single-family rental properties in your hometown, start there and expand slowly. Avoid commercial real estate, out-of-state markets, or complex partnerships until you've mastered the basics. Hassan learned that expertise in one area doesn't guarantee success in another. Ali proved that deep knowledge in a narrow field beats shallow knowledge across multiple fields. The carpet weaver who tries to mine gems usually loses both his rugs and his jewels. You've just discovered Warren Buffett's 7 rules that separate real estate investors from real estate gamblers. These aren't get-rich-quick schemes, they're get-rich-certain principles that have built more real estate fortunes than every flashy strategy combined. Here's your bottom line. While everyone else chases appreciation stories and leveraged dreams, you now have the blueprint to build real wealth through cash flow, patience, and disciplined investing. Stop looking for shortcuts and start following systems that actually work. Your action plan starts today. Find one property in your local market that generates positive cash flow from day one. Calculate the numbers conservatively, buy in a location you understand completely, and plan to hold it for decades. That single property, purchased and managed using Buffett's principles, will teach you more about building wealth than any real estate seminar ever could. If these 7 rules have opened your eyes to how real estate investing actually works, I want to hear from you. Comment Buffett rules below and tell me which rule hit you the hardest. Was it the leverage warning, the location lesson, or the circle of competence reality check? And if you're hungry for more wealth-building strategies that actually work, instead of just sound exciting, let me know what topic you want me to tackle next. Stock investing principles, business building fundamentals, or retirement planning strategies that don't depend on market timing. Remember, every real estate fortune starts with the same decision: choosing principles over promises and patience over pressure. Warren Buffett became Warren Buffett by following boring rules that produce extraordinary results. Your real estate empire starts with your first smart decision, not your first big deal.